coming from Banque de France at the time, pointing out the fact that it's very interesting in a way that we have at the Supervisory Board, SSM Council, an American, and I think it's very interesting, and I don't know how in the US they would be able to replicate such an experience, but at least for Europe, as you know, since the 2008 crisis, risk supervision is a key issue, and especially the cultural dimension about defining risk, addressing risk, defining a risk culture, both sides, at the supervisory level and at the financial institution level, and how, based on this common approach, and common approach is a quite important thing, because we think in Europe that we had some kind of gaps of understanding by the way financial institutions should address or was addressing risk in the US versus in Europe. Even in Europe, we don't have always the same level of cultural tradition in defining and practicing risk. It seems that in France, I don't know if we are right, but we think that we have for a long time a very deep risk culture, and the result of that was that probably in the crisis, 2008 crisis, the financial services system in France was more resilient than the other countries. We think that this culture is very important. We think that the chain of risk control or surveillance is important. And when I speak about the chain, is all articulation between what we are doing internally and externally. We think that we had quite intimate relation with the ACPR in France. Intimate doesn't mean that there is some collusion, but it means that we share the same cultural approach and the same importance that we gave to surveillance. Now, what is interesting is how, coming from your previous responsibility of being a consultant on regulation and supervision, now coming from the US in this very important institution of ECB, you must have a special regard on what is happening, and all this cross-fertilization process between this SSM approach, which is more or less under construction, this deep American approach also less under construction, probably. And what is your regard? What are your first reaction looking cross-border, transatlantic, and what would be your messages about how we can first improve what we are doing in Europe, and also how we can improve our relation between our friends from the US on certain issue? Okay, Elizabeth, you have the floor. Thank you.
Thank you, Edouard. Thank you very much. I want to say before I start with your extremely important question that my heart goes out to everyone in France for the rising COVID experience that you are having, and my wish that it will not be so terrible, and also my solidarity in the face of the terrorism events that you are experiencing in these days. I remember very well when I was banking superintendent in New York, and we were also faced with acts of terrorism. The solidarity that I felt from my supervisory colleagues, we had a very strong cooperation in my days in supervision in New York, and my thoughts and prayers are with everyone today. It's really a pleasure and an honor to be with all of you, and Edouard, thank you and all of your colleagues for inviting me. In sharing my views first on the European system of banking supervision, it seems really appropriate to spend a moment looking first at our shared history and our shared traditions. Europe is home to the world's oldest still operating bank. It was created in Italy in the Middle Ages, and not long after that, local banks began to flourish all across Italy and Europe, offering very decisive support to local economies and their vibrant commercial endeavors. And across the Atlantic in the US, the charter for the first state bank, my alma mater agency gave that charter. The Bank of New York was given in the late, and then the first New York banking law was adopted in the late 1700s, thus initiating a long-standing tradition of state banks flourishing across the country. The New York State banking law, it's the oldest in the nation, and it began the tradition of classifying activities performed by banks as incidental to banking. And this laid the foundation for the evolution of banking in the following centuries, first starting at the state level and then going on to the country level through the introduction of the Federal National Banking Act. So you see, there are similarities between the European and the US banking system that have a very long history. Both European and US banks started with the cultural tradition of serving the needs of the local communities. Each of them earned an important place in society by providing an essential service, by supplying the lifeblood of commerce to the local economy. Banking supervisory authorities on both sides of the Atlantic evolved very similarly as well, steeped in the customs of protecting their local communities and armed with the local knowledge about risks and what the needs were in those communities. Indeed, today's banking sectors in Europe and the United States are still characterized very much, foremost by serving the essential needs of the local communities, even if some of the banks also operate on a global scale. The great financial crisis then brought significant change to supervision in both jurisdictions, culminating in much more emphasis now being placed on delivering effective supervision through the adoption of a consistent and a common approach. The supervisory system in the banking sector of both jurisdictions now face very significant challenges too in these days, having to manage emerging risks while also staying very much attuned to prevailing headwinds. These are currently determined to a great extent by the digitalization that we're experiencing, and also, of course, the COVID-19 pandemic. Both developments are ushering in changes in the banking sector, with COVID-19 likely to also affect very much the creditworthiness of a number of businesses. I don't know now whether one system will prove ultimately to be better equipped to deal with the challenges ahead, but instead, with great respect for the cultural traditions that are embedded in our DNA, I would posit that there's learning to be gleaned from both systems. And that's why today I will draw some parallels between the supervisory traditions and the developments of the banking sector in the EU and the US. As a member of the supervisory board of the ECB, my objective is to embrace any lessons that can lead to an even more effective European supervisory system and ultimately result in a much stronger banking system in Europe. Before I focus on some of the similarities and the differences in our supervisory traditions, it's worth acknowledging where Europe now stands. Progress achieved in harmonizing regulation and banking supervision practices across Europe in the wake of the financial crisis has been nothing short of remarkable. European regulations have been strengthened through the implementation of global standards that are directly applicable to all of the banks operating in the European Union. European banking authorities produced a unified body of over 250 draft guidelines and technical standards, and common definitions of capital and liquidity requirements are now applied consistently across all of the Euro area banks. Moreover, following the establishment of a single European supervisory body for the euro area, Pillar 2 requirements started to be implemented uniformly across all euro area banks, applying to significant and less significant entities alike. ECB banking supervision has tightened its internal quality assurance and its consistency checks to ensure that there's a real level playing field for all banks. It published Pillar 2 requirements for individual banks for the very first time this year. It gave guidance and took supervisory decisions to address the large stocks of NPLs held by euro area banks, reducing them from 6.5% in 2016 to 3.2% at the end of last year. It seems unlikely that national policies alone would have resulted in the same results in such a short period of time. What's more, this same ECB guidance, same NPL guidance, is now key for banks to weather the economic downturn as the consequences of the COVID-19 pandemic unfold. Much like Europe, also the US supervisory regime started at the state level and then converged toward more centralized supervision. Disruptors to delivery of banking services emanating both from innovation and significant risks such as the pandemic mean that supervision cannot stand still on either side of the Atlantic. Centralized systems of supervision need to be dimensioned appropriately today to deliver both efficient and effective supervision. A brief, but not by any means exhaustive analysis of the similarities and differences in our supervisory traditions might be of help in delivering this next, more efficient and more effective stage of supervision in Europe. Differences in our cultural traditions are evident at once framing how supervision is delivered and the direction also that it will take, the direction of travel. They also travel into different views in terms of the risks that we need to manage and the actions that we might need to take. I'd like to give you a few examples. First, let's start with the legal tradition underpinning supervisory practices in the US and in Europe. In the US, banking historically has been connected to the development and the expansion of the activities that are considered to be incidental to banking. And interesting, in these days, we may be seeing another shift in the definition of incidental to banking, resulting from the push to embrace technology. In the US, fintech banking charters are emerging that may ultimately disconnect the definition of a bank that now exists in the US from the deposit-taking requirement. While this is currently under some legal challenge in the US, question for us today is really whether it opens the way to technology companies being classified someday as banks without engaging in deposit-taking activities. Europe, on the other hand, has enjoyed a much longer tradition of a more flexible definition of what constitutes a banking activity, especially here in France. In Europe, the definition of banking activity provided for harmonization initially, while at the same time maintaining degrees of freedom originating at the national levels, such as in France. For example, some countries in Europe have adopted a broader definition of a bank without deposit taking as a limitation by allowing consumer credit lenders and leasing companies to be classified as banks, and investment firms also are classified as banks. So if taking deposits is no longer a necessary condition to be a bank, will large technology companies ultimately become banks? Will payment transfers and virtual currencies become more important for supervisors to safeguard than even the deposits themselves? These are the kinds of questions that underpin the very nature of supervision in the years ahead on both sides of the Atlantic. The answers have far-reaching consequences for the level playing field and indeed for how the future of banking will be delivered ultimately to continue to prudently supervise activities in local communities. They also require that we continue to develop our supervisory models and ensure that they're fit for purpose, fit for the future. The answers require us to continue to develop them in a very prudent way, I would say. So let me now turn to the tradition of sanctions and enforcement, first in the United States, because that's where we see the most profound difference between Europe and the US. And it relates really to the level of the hefty monetary penalties US banks, including the foreign banks operating in the US, have been subjected to under federal enforcement actions known as consent orders. While we may question the level and the efficacy of the fines, consent orders have also had strong remediation requirements in addition to the monetary sanctions. These remediation requirements have required improvements in governance, internal controls, technology systems, all geared to support enhanced risk management. Also covering data and risk data aggregation activities. These remediation activities, most bankers will tell you, are far more costly than the monetary penalties in most cases. And arguably, from a supervisory point of view, they've had a greater effect than the monetary policies on strengthening the banks. The validation of these remediation requirements is also embedded in the supervisory examination process itself to ensure that they are taking place. And lastly, just to touch on inspection traditions, these also differ across the continents. In Europe, there's a tradition of separating the offsite and the onsite. There are ad hoc independent onsite teams separated from the dedicated joint supervisory teams. And these are reviewing bank practices and policies on site. And then they benefit from a significant degree of freedom to deliver very demanding outcomes and impose strict remediation on the bank. Sometimes these inspections last many months. And then these are followed up on by the joint supervisory teams operating in a different department. In the US, designated supervisory teams reside in the largest banks, are actually on site with dedicated offices, and they conduct their supervision from there on a day-to-day basis. In other words, the on-site and the off-site surveillance are more connected in the US and they're more separated in Europe. There's an interesting difference in inspection traditions related to the stress testing practices of both continents. Both regimes deploy forward-looking stress scenarios to measure the resilience of the banks and then adjust the capital levels accordingly. In the US, the CCAR stress test is a top-down exercise for just the largest US banks. And significantly, the exercise is strongly underpinned by the fiscal backstop that was initially delivered during the financial crisis, the TARP program, I'm sure you're very familiar with. US bank capital planning is an intrinsic part of the stress test exercise in the US. The CCAR, for example, incorporates the capital actions submitted by the banks at the beginning of the exercise into the stress projections, and then the banks revise the capital actions after the CCAR preliminary results are communicated back to them. There's also the tradition of publicly making available the pass-fail. Europe conducts a bottom-up stress test on many more institutions, over 100 significant institutions under the direct supervision of the ECB. And the results of that stress test exercise help the supervisor set the Pillar 2 guidance and inform the supervisory teams about the overall quality of the bank's risk management practices on a holistic basis. That's then factored into the SREP, but the timeline and the setting of the P2R levels occur at a different moment in time. So the link between the stress test performance and the supervisory decision that ultimately comes is thus addressed more holistically through the SREP process, but the slight disconnection in time frame might hamper a more clear-cut understanding by markets of the exact supervisory use of the stress test results in Europe. So let me talk just for a moment about facing the pandemic and some of the profitability challenges. In the immediate aftermath of the great financial crisis, the US banks that received public support were prevented from buying back shares, from distributing dividends, or pursuing growth strategies, doing acquisitions, for example, for a number of years. So they had to turn inward. They focused on rebuilding balance sheets, on restructurings affecting their business models, and investing in technologies so that they could reduce costs. I think we would do very well today to recognize that the now somewhat higher profitability of the US banks comes only after a very long decade of depressed returns. Persistently low interest rates forced US banks to revise their business models, reevaluate the size of their branch networks, and seek out new sources of revenue that met the consumers' preferences for digital interactions. Meanwhile, European banks were also struggling to restore profitability over the last decade also. owing to the effects of the sovereign debt crisis that produced the long-lasting stagnation in many countries. But thanks really to the decisive steps taken by predecessors of mine around the world, and these were steps taken in the wake of the financial crisis on both sides of the Atlantic, both the European and the US banks entered into this COVID-19 crisis with larger and more resilient capital and liquidity buffers. And the COVID-19 pandemic has delivered the most severe blow to the US economy since the Great Depression. Same is true in Europe. And the actions that the Federal Reserve has taken to address the crisis were similar in immediacy, magnitude, and the goal to those put in place by the European banking supervision. In both jurisdictions, the immediate priority of supervisors has been to support the efforts of the banks to sustain the flow of credit to households and firms during these challenging times. It's the most important thing. And both European and US banks have benefited from extraordinary, historic support since the beginning of this crisis. And today, they also both, in many ways, face similar challenges. And now, the largest banks in both jurisdictions are provisioning for future losses at record rates. US banks seem to be doing this at a slightly greater rate on first glance, but one must really bear in mind that the portfolio composition of the US banks differs rather significantly from that of their European peers. In the US, for example, consumer lending and credit card businesses weigh far more in the balance sheets of US banks than here in Europe. But the point here is that in the face of the crisis, the importance of provisioning for likely losses is paramount on both continents. This will position them to absorb losses and lend to viable businesses through the most severe period of this crisis and to be poised for growth from the very onset of the recovery. Going forward, fortress building the balance sheets will be as crucial for the banks as fortress building their technology infrastructures in order to reduce costs. This will require banks to scale up both in their IT budgets and in their size. And here, consolidation is an avenue worth exploring, particularly in Europe, where much can be gained in terms of overall cost efficiencies. In the US, almost 500 banks were wound down during the financial crisis. This came after a consolidation process that had already been going on for some time. And in Europe, far fewer banks have been wound down or actually failed during the same time frame. Weaker banks have managed to stagger on, exerting pressure on margins for the rest of the sector. And since 2012, what have we seen? Only an average of 2 transactions have occurred every year where the buyer acquired more than 20% of another bank. And the picture is only slightly different for the domestic markets overall. An average of only 11 mergers and acquisitions have taken place annually between 2011 and 2019. The size of the European banking sector is much larger than that of other sectors of the economy, different from the US, and the banking assets are very large relative to GDP, although some of this can be explained by the relative importance of the bank funding channels. There are other funding channels in the US besides banks. It still stands to reason that there's overall excess capacity, and this overall excess capacity produces an unwelcome hangover effect on the European banking sector. So I had said earlier that consolidation is one avenue to the future. It would enable banks to diversify sources of income, foster private risk sharing within the banking union itself, and this would be a strengthening event in and of itself. This in turn would make the euro area on aggregate also more resilient to idiosyncratic shocks. So the harmonization achieved since the last financial crisis definitely made it easier for banks to operate across borders, and it's also made the banking sector safer. But the euro area banks do not yet fully enjoy the banking union as a truly domestic European market. The segmentation of the euro area banking is one of the most worrying legacies of the financial crisis. It was, and to a certain degree still is, widely believed in host countries that in times of crisis, parent companies will protect their own interests and home authorities will prioritize their own national objectives. And this lack of trust is what we're seeing. It's reflected in the low levels of cross-border banking within the euro area. We've undoubtedly made progress in designing a stronger crisis management framework with much greater reliance on private investors being bailed in rather than on the banks being bailed out by governments. The establishment of the Single Resolution Board and the Single Resolution Fund have been really important steps in this regard, but the safety net's not yet fully in place at the European level. As long as deposit insurance is remaining national, member states will have the incentive to ring fence their banking sectors. And that's why we need to finalize the banking union by establishing a European deposit insurance scheme. That'd be a very decisive step toward making it easier for both European and national legislatures to eliminate the remaining regulatory provisions that trap capital and liquidity within national borders. I am aware, though, that a fully fledged European deposit insurance scheme is going to take some time. That's just a reality. Until then, there are steps, though, that we as supervisors can and we will take to try to dissolve some of that ring fencing to the extent that we can. The crucial point here is how we can deal with cross-border banks that encounter some difficulties. Resolution strategy, group recovery, and resolution plans should play an essential role in this. If we want to strengthen confidence in crisis management in Europe at the European level, the best way forward is to reinforce cooperation with respect to the role of group recovery and resolution plans, as well as their practical implementation. ECB banking supervision will continue to put a lot of effort into strengthening the usability, the practicality of these plans, but we're also taking another additional step in this direction, and we're considering offering banking groups the option of having subsidiaries and parent companies enter into formal agreement to provide each other with liquidity support and to link this support to their group recovery plans. This should not only help to explicitly map out how group entities can support each other when the difficulties arise, taking into account local needs and restrictions, it should also make possible to establish appropriate triggers for providing the contractually agreed support at an early stage in a difficulty process. In the US, both the resolution and the insolvency of deposit-taking credit institutions are covered by a single bank insolvency framework that offers both the resolution and the liquidation tools. All insured credit institutions are resolved or liquidated under the FDIC, the Federal Deposit Insurance Act, which provides the FDIC with the resolution powers to arrange purchase and assumption transactions, set up bridge banks, and to deliver on liquidation policies. There's no doubt that the single deposit and resolution scheme has helped interstate consolidation over the years in the US. So let me just sum up. To leave the past behind and move decisively into the future, banks will have to address the challenges of the present. It's no different than any other time. Fortress building balance sheets now can pay significant dividends in the future by enabling loss absorption and facilitating lending to viable businesses. But there are other challenges that are structural. The digitalization of the banking sector, disintermediation of financial services, these are irreversible trends and they require banks to gain scale if they are to tackle them effectively. So regardless of their different traditions, US and European banking supervision will sooner or later have to address the same question. How will our supervisory framework continue to ensure the safety and soundness of banks and through them provide the lifeblood of commerce to local economies? How will we continue to evolve? Maintaining an open dialogue and a very strong collaboration over the Atlantic will be crucial to answering that question. I'm very happy to have been with you today, and thank you very much for listening.
Elizabeth, thank you very much for this very clear presentation. Very interesting ideas about how we are following a common path, or how we are similar or not similar, and especially for European issues about fragmentation, critical mass, and internal cross-border issues that we have at the level of groups. We don't still have a concept of pan-European banks. We still have, just as a concept, a French bank or German bank, or I don't know if it still exists, a Polish bank. And that is a problem. And if there is some initiatives to manage liquidity inside the groups that can overcome this major problem, that would help consolidation of the European banking system. Now, I give the hand to Michel to organize questions and answer. Michel?
Yes. Yes, thanks very much, Elizabeth. It was really interesting and really a pleasure listening to your view, and we deeply think that we are quite privileged having you here today for an overview of the differences and similarities between the two supervisory systems. So the idea now is to discuss openly with people raising hands to ask for questions. You have an icon on your screen, all of you, and you can raise your hand so that we can give you the image and the sound to ask for questions. I'll start maybe, Elizabeth, for a general outlook of the supervisory landscape on both sides of the Atlantic. I don't have a clear view, to be honest, on where is the most fragmented system for regulation and supervision. Is it in the US, where you have a number of different entities? You, of course, have the Fed, you have the OCCs, the CFTCs, the SEC, maybe for some activities. We in Europe have a number of agencies. Well, at least in banking, we have one which proves certainly useful. Well, how do you see the global picture? Is it more fragmented here? Is it more fragmented over there? And how efficient is it globally?
Yeah, it's a great question, Michelle. Excuse me. The very interesting thing for me is that I find in Europe there's a view that the US regulatory system is so organized and very monolithic. But I can tell you, as I was served in office for a number of years at the state level, at the New York state level, probably one of the most important supervisors in the US. It's a very rich system with a lot of points of view and a lot of regulatory traditions that come into what in the US is called, maybe not so positively, as the alphabet soup approach to supervision, with many different agencies with responsibility. So banking over deposit-taking institutions, the SEC over investment, securities and institutions and securities activities, the CFPB with responsibility over consumer following on the subprime crisis, and of course 50 state regulators that have a myriad of responsibilities. So it's a far more diverse regulatory picture in the US than I think is commonly known in Europe. I find Europeans criticize the numerous regulatory agencies that are here probably more than they should when they try to compare it to the United States. I also come from the state tradition, not the federal tradition. And so, I have very much an appreciation for the national competent authorities. Part of what I'm trying to tell you today is that innovation and definitions of what a banking activity is, that's something that the tradition started at the state level. And so it's something that should be valued and should have some way of moving into the overall regulatory picture, even as we correctly move toward much more centralization, which is necessary because our banks have become more active across borders and have engaged in different activities. So I don't think that there is one that is less or more fragmented to the other. I find them very similar, to be quite honest.
Okay, thank you. I don't see hands raising for the time being. So, okay, Véronique. Véronique Ormedsen, no. You may know Véronique. She's the head of the regulatory affairs of BNP Paribas. So, Véronique.
Thank you very much. Can you hear me?
Yes.
Maybe you can even see me.
Yeah,
thank you very much, Elizabeth, for your remarks. Really very interesting. There are 2 points that I would like maybe you to come back on or in a little bit more details. I was really interested by your comments on the differences in structure of bank balance sheet as potentially maybe a partial explanation for the very different patterns in terms of provisioning that we have seen since the beginning of the COVID crisis. I think that is a very surprising aspect when in terms of benchmarking, and beyond your comments, also any comments you could make from your ECB point of view in terms of precisely either across the Atlantic or even within Europe, the extent to which benchmarking practices on things like the NPL ratio, for example, makes sense or doesn't, or how it can fuel into the supervisory process. So that's one. And my second question is a word that you didn't pronounce at all, but maybe you alluded to when you talked about the differences in financing structure, which is securitization and the very famous GSE system in the US. To which extent do you think that this is obviously a structural difference between the 2 systems, and any advice that you could give to your European colleagues in terms of how to bridge the gap, maybe not in creating European GSEs, because that would be probably maybe not inappropriate or very long shot, but any like the revival of securitization. What is your view on what is on the plate of the CMU in particular on securitization? Thank you very much.
Thank you. Thank you for your question. First of all, just on provisioning, we're at the point where starting in March, the lockdowns began. It's been an extraordinary year. The COVID-19 is something no financial institution has experienced. The effects of pandemic, also supervisors. There's been no playbook for us to refer to about how to walk through these processes. In the very beginning, as I mentioned, the objectives were really quite clear for us. Support the overall banking system. Let's not have this health crisis become also a financial crisis. Let's not have an event that is based on the need for access to liquidity, to have that continue, that lifeblood of commerce, utterly essential for the running of the economies. Having that continue, let's not let it also turn into a solvency crisis. And we've been very effective at that. I think every policymaker that's contributed to that picture, every banker that has kept its operations open and its people working and contributed to protecting health is really to be thanked for extraordinary efforts in this regard. But now we are at the point where more is known. We're also at the point where we know that the health crisis is unfortunately continuing. And so it becomes extremely important for us to start to sift through what the structural changes may be in the underlying real economy, and to have a really careful look at what the viable businesses are and what those non-viable businesses are likely to be, even if fiscal structures and fiscal supports and moratoria are remaining in place. It's really essential for us to have a look through to the underlying credit analysis. And the fact is that this crisis, this pandemic crisis, is going to go on longer than we like. And it's also the case that it has a real potential for making structural change in the underlying economy, with which businesses will be more or less vibrant as we go through this. So we've been giving very strong advice to look carefully at what the provisioning needs to be to make decisions about which credits are likely to move to stage 2 and to become unlikely to pay, and to be rigorous in that regard. I think there's a very important thing that you're raising about the NPL guidance that was given and the experience with the practices on the management of the NPL. This is something we're really benefiting from. The banks that went through very strong NPL provisioning processes in the last crisis have built very strong operational units to manage the flow of the NPL. And to use an analogy, in some way, this gives something of an immunity to those banks because they've got the gears greased and working. Other banks are going to have to build that didn't have to suffer through as much of an NPL overhang in the last crisis. And it's essential to build those operational structures and that capacity to be able to manage that flow. So going forward, I think we will be seeing much more clarity about what the levels of provisioning need to be, and we're looking very rigorously at whether or not there's been a discernment between viable and non-viable businesses. As to your second question, I would never venture to say that you should develop GSEs in Europe. It wouldn't be my mandate to do such a thing. I'm not a policymaker. But having said that, I will comment on securitizations. There are benefits and there are challenges coming from developing a securitization market. The benefits are many. The economies of scale, the cost structures related to securitizations, the creation of depth and breadth of a secondary market can serve to lower the borrowing costs and create a more rational flow of liquidity for markets that need them. But there are cautions also, and in the US, they learned very well that if there is not the appropriate oversight, regulatory oversight, not the appropriate understanding of the risks inherent in disintermediating the lending from the secondary market, where you cannot have line of sight into building risks in the securitization market, well, that's how a subprime crisis is born. And so I think in Europe, we can benefit very much from the learning that the US went through and do it better.
Okay. Other questions?
Yeah, maybe I would have another question with, we have a big debate with the financial industry in the US around leverage ratio versus internal models. We think that internal models is not just a way to optimize the cost of capital, but it's also a very profiled tool to manage risk and to better understand risk internally. It's a guarantee that the risk is properly managed. We think that a leverage ratio is a kind of a middle-aged type of measurement of risk, because all risk has a level the same weight, and that can drive to bad conduct in a certain way. The issue with internal model is the trust that we can build with regulators on how this internal model is constructed, what are the parameters, and so on and so on. It means that the condition to have internal models is to have a high level, no asymmetry of understanding between both sides, between internal risk control and external risk control. What is your view on this balance between level ratio and risk, internal risk model?
Thank you. Edouard, I will answer part of your question because I don't feel enough of a student of the history of the leverage ratio to answer you completely, but I'm happy also to look at it and follow back up with you. So let me just comment on the internal models, if you don't mind. You know, it's true that internal models, there's been a great tradition of building these with a very important and credible rationale behind the building of the internal models. And that is, you know, it's a way to really have line of sight into emerging risks and to have not just a qualitative view about where risk is emerging, to also have a quantitative view and to have the ability to make appropriate risk measurement based on some quantitative analytics. It's a tool in the end, the internal models, that now contributes very much to our view about even provisioning, our view about incurred losses, our view about what the appropriate levels of capital are. As we sit here today, I think it's important to recognize that many of the internal models have been very challenged in the context of the pandemic. And it seems that even in the last crisis, the internal models were quite challenged. So I leave you just with a question and the thought that, you know, what more could we be doing to ensure that our models are not ivory tower, that they are very connected to very real and very present market circumstances, and what can we do to make sure that the way we use the models is actually giving an appropriate picture about what the right level of incurred losses, the right level of provisioning, and the right level of capital adequacy really are. And to the extent that this tool needs other ways of buttressing the information that comes from it, how do we go about doing that? I think these are questions that we should be all thinking about in this time.
Yeah, thank you very much. I think you have the right question. I think that in France we try to give some answers to those questions, and probably we have to bring back those answers to the regulators to rebalance these approaches. Okay, Michel.
Maybe if I just add one more point there, if you don't mind. You know, what we are hearing that a lot of institutions have recognized that models haven't been perfect in what their outputs have been in the last months, and for some of the projections going forward, and they need to use overlays in order to correct for the overall picture. This is both a positive because the recognition is there, and putting overlays in place means that appropriate diligence and recognition of risk is there. It's also a question. So if the model isn't producing the right results, well, what do we have to do to buttress that?
Okay, thank you. Michel?
Yeah, I see a hand raised.
Michel Perez, yeah.
Michel Perez from
New York, I suppose.
I guess so. I'm trying to give the voice to Michel. Celia, can you help me?
C'est à lui d'allumer son...
Michel, tu peux mettre ton micro?
Oui, je crois que ça y est. Vous m'entendez?
C'est bon,
oui.
On t'entend.
Très bien.
Well, good morning, Elizabeth. It's nice to see you. We're just across from the bay from each other. Thank you for a very good expose. And my question is about the coordination of enforcement. You alluded to the different tradition in supervision, which created some tensions in the past. Yet recently, it seems that there is a concept that supervisor probably should hunt together rather than separately. In the case of France, we have seen two very important parallel settlements with the American authorities in the case of Société Générale and Airbus. There have been other settlements with many other European countries. Do you think this trend will continue? First part of the question. And secondly, what could be done on both sides of the Atlantic to make this coordination in terms of enforcement more efficient?
Thank you. Thank you, Michelle, and hello to you. Thanks for attending today. And thanks for your question. So on the first, you know, I think you can tell from my remarks that I very much favor coordination, maybe especially in the enforcement arena, and especially for institutions where there is a global footprint, and there are a variety of markets that the institution is operating in. To have one supervisor on one side of the ocean or the other take a unilateral action is, first of all, extremely disruptive to the overall market. And second of all, it doesn't engender trust and collaboration and cooperation, which has to be a hallmark of strengthening a globally effective supervisory framework. So I would be extremely strong in my view that coordination of enforcement is necessary. Now, there's an exception to that. Sometimes we see supervisors take actions that are unilateral, and the other supervisors simply do not agree. And there it's completely appropriate that they stand back and not join an overall global settlement with an institution. And I think we have to recognize that, you know, that may happen for very good reasons. There may be a very local issue that is only affecting that local market where a supervisor takes an action. So we would say that's an appropriate thing to do. And it may be that we don't agree because sometimes politics gets involved. And, you know, so I've seen both examples of those in my experience. But as an overall statement, then the really important policy objective is to have coordination and collaboration. So on your second point, what can we do? And I think a lot is being done. The colleges are meeting much more regularly. I think supervisors need to know each other. Relationships matter. These are things that perhaps we need to focus even more on in this time of the pandemic, where it's less easy to meet with each other. So, you know, here, I think making sure that some of the international bodies are able to collaborate formally and informally will help engender trust, and will also make for a much more coherent and understandable to the market enforcement regime that needs to be put in place. I hope that answers you. Thank you.
Thank you.
Elizabeth, I have noted a number of
Benjamin.
items. Okay.
Yeah, Benjamin.
Hi, can you hear me?
Yes.
Hi, I'm Benjamin Achibili from the French Minister for the Economy. Thank you very much for your presentation, which was very interesting. I would like to know what are your views about the supervisory power of the SSM on European branches, European subsidiaries of American banks. And I'm thinking more specifically on one specific topic, which is the relocalization of compensation activities. And I guess you know that it's one of the goals of the European zone at the moment. So I would like to know what are your views on this topic. Thank you.
Thank you. It's a complicated subject. So let me answer you in two ways. First, my view is that there should be coherence, and the coherence with the power of the SSM related to the European subsidiaries of American banks. There should be a level playing field in place, and there should be a coherence to the supervisory framework that's delivered to both domestic European institutions and foreign subsidiaries and branches that are operating in Europe. It's the same thing that I would have advocated for as a US supervisor, that there should be coherence of treatment between like business models, like activities, like size, whether that institution be a domestic institution in the US or a foreign subsidiary or branch operating in the US. So my first response is that we really need to aim toward coherence. It's fair and it helps markets operate most coherently. Second, related to the compensation activities, here is where I indicate that it's probably a bit more complicated. There are I'm aware that there are very precise competitive pressures afoot in both European and US institutions when they operate in a variety of markets. So particular businesses, the competitive aspect is an important one to take into account. And why is that the case? Well, talent is something that is developed, is nurtured within an institution. You're also delivering, I hope, very strong cultural values for risk culture into that talent as you develop it. And if that talent is wooed away by a compensation package to another institution, it can have a destabilizing effect if that happens in a very large way. So, there's also the risk to the revenue production of institutions and their delivery of talent. I know that there was one institution in the U.S. that had a very strong principle, which was that their most important asset was their people. And so this is where, I think we need to make sure that when we have oversight over compensation activities, that this component is being taken also into account. I also think that, we have to be very wary of very incorrectly incentivized compensation packages that drive the wrong risk culture. So there are very good reasons to have this kind of thing in place. So I hope that answers your question.
Okay, Michel?
Yeah, in your comparison, in a way, of the supervisory traditions in the US and the EU, you mentioned a number of items. One was about if I noted well, about the definition of credit institutions, with maybe here in Europe a broadening of the definition of credit institutions, which has a consequence on the scope of supervision. And I have a question about that, which is, are you for advocating for a broad view of what a credit institution is? And you mentioned payment transfers and virtual currencies. Should that really be included in the global sort of banking supervision? And I have a second question about sanctions that you mentioned also as maybe a difference. And I was willing to know if you were also advocating for higher sanctions in Europe, because it seems to be a bit lower on our continent than it can be in the US. You also mentioned as a difference the practice of stress testing, with a more top-down approach in the US and a more bottom-up approach in Europe. So, about this stress test, are you advocating for a more prescriptive view of of the level of stress tests in Europe, more than it is at the moment? Well, three questions, Elizabeth, in a row.
Yeah, and I thank you for asking them, because I definitely want to answer them as much as I can. So on the definition of a credit institution, advocating for a broader view, no, I'm really trying to recognize that very interestingly, innovation has occurred in what the definition of banking is, both in the US and in Europe over time, and starting at the local level. Starting at the state level in the US and starting at the national level in Europe, you've seen a definition of banking moving from what a bank is and what the definition of a credit institution is in similar ways, actually, and then moving more towards centralization. I think that we're now seeing, even if there was innovation that occurred before the centralization in both markets, we're now seeing questions arising that maybe aren't so new. I also want to say that, the introduction of ATMs, for example, was this a banking activity? Other kinds of payment processes, were these banking activities? Could they be considered part of banking? But I see today questions that we need to explore about what the bank of the future will look like. And I don't have an answer for you now, but I think it's important to have in mind, what is the future of banking? We're definitely seeing disintermediation of some of the banking activities being something that citizens are buying, if you will, whether it's with their phone using payment apps or things like this. So I don't have an advocacy position for you here, merely a recognition that there are questions that are definitely going to have to be addressed. As for sanctions, no, I am not an advocate for replicating the sanctions levels that have occurred in the U.S. Please allow me to make that perfectly clear. I have questions about the levels that these sanctions reached in the United States, and I do not think that the fines themselves are an objective that we should be striving for, which is why I wanted to make also clear that the remediation that's contained in those consent orders, these are things that can really be helpful, and and whether or not we should be doing more, whether or not there's a need to be doing more, I don't have a comment. But I recognize that there are some differences here. There can be some challenges to doing that. There can be some opportunities and some positive reasons for doing it. And again, I don't have the answer there. On the stress test, it's very striking how much stress testing we do in Europe and how detailed bottom-up an exercise we undertake. I don't prescribe for a change or advocate for a change, but I think it's worth studying as we move toward, we're 5-6 years old at this point at the SSM. Is there another step that we could be taking as we develop richer data, richer history? And would there be benefit to approaching something of a top-down exercise when we're able, with more data in hand?
Okay.
Okay, I think there is Véronique coming back, and somebody else.
Jean Cheval.
And Jean. Okay. In which order? Okay.
Véronique, ladies.
What's your time constraints, Elizabeth?
Let's just how about 2 more questions?
Okay. And Elizabeth, and then Véronique and Jean.
Thank you. I can't avoid to ask you a question on distribution strategies. Obviously, I'm not expecting you to comment on the thought process that are currently probably quite active within the SSM, preparing for the December communication. But because your talk was really about supervisory culture. Could you comment on how you see this difference in culture from maybe the perception of the importance of dividend payments on both sides of the Atlantics from a financial stability standpoint?
Thank you for the question. Yes, in December we'll be making our next communication about the dividend policies. I will simply say today that it was an extraordinary measure that we put in place. It's meant to be something temporary. And we really are focused on evaluating the data as it's coming in and what the macroprudential environment looks like and what the capital planning activities of the banks are as we look at the dividend policies. I wanted to also emphasize a point I made in the speech, and this is not at all meant to be prescriptive about where we're going to go with the dividend policy, because we simply don't know the answer to that question yet, and we will be communicating on it. But I think it's worth noting that there's not a different tradition on either side of the Atlantic. In the severity of the financial crisis, there were years where the American banks we're not allowed to pay dividends, and maybe we forget. But I certainly don't hope that's an outcome here either. So thank you.
Jean?
Yeah, thank you, Elizabeth, for your expose, which was very rich. I suppose you have been surprised by when you arrive in your difference in profitability between the US banks and the European banks. For European banks is probably at the moment 50% of what it is in the US. But you mentioned that the profitability of the US bank has improved. It was not that high not too long ago because of the persisting interest rates, low interest rates. The US banks have been forced to adapt their business model, and they have been successful in doing that. My question is, do you think that the European banks have not followed the same path in terms of adaptation of their business model? Because the reason you mentioned the very low interest rates in the US is even more truer for Europe, where we have been living with not only with low interest rates but with negative interest rates. So that should have been even more crucial element for European banks to adapt business model. So my question is twofold. Do you think that we are lagging in terms of innovation, or do you think that there is this is because of this fragmentation, the segmentation of the European banking market? Is it that factor which is the unique cause of the differences between the two banking systems?
Thank you. Thank you. Yes, I very much mean to recognize that low interest rates have been in place in both Europe and the US, and that the global banking sector has had to reframe its activities in the context of the low interest rates. And I guess low interest rates are going to be in place for some period of time going forward, if one believes most of the economic data that's out there and what we're being told by the economic experts. So it's incumbent on institutions on both sides of the Atlantic to adjust the business model. This is a reality. And I don't at all intend to leave the impression that US banks have done a better job at that and European banks have not. It's not at all what I think. I think that all banking institutions need to adjust their business models, need to pivot, need to find ways of generating cost efficiencies, and need to be extremely focused on how can technology, for example, deliver some of the cost efficiencies. How can consolidation deliver some of the cost efficiencies that may be needed to strengthen the overall profitability picture. In Europe, of course, it's important to recognize that we not only had a great financial crisis, we had a sovereign crisis and a doom loop that came into place with a linkage between the sovereign risk and the banking risk. And very importantly, that loop has been broken. But that a term in Europe than it did in the US. So I find that, from a timing point of view, and given that the conditions have been set up so that there's a stronger overall picture, given that the sovereign risk issue has been broken, and so that there has been a consolidation across Europe with a unified banking system that has contributed very much to that the conditions are being set in a more positive direction of travel for the European banks. So no, I don't lagging at all. I would rather focus on what are the other conditions that need to be put in place to also contribute to a picture that can deliver a return to profitability. And that includes making sure that our banks are focused on the business models. That includes making sure that we can minimize the fragmentation in the overall market as much as possible so that consolidation and cost efficiencies can be achieved. So thank you.
Okay. Yep.
Well, I just wanted, I know we had two questions, Elizabeth, but maybe a short last one, just for, I think the ECB is very privileged to have your experience in board and your culture, American culture, in board as well. Would you advocate to have the reciprocity in the Fed and have a sort of crossover position as the one that you have at the moment at the ECB, gaining experience and culture from abroad? Is it just conceivable in the Fed system?
Let me say first, it's I that is honored and privileged to be part of the European banking supervision. It's a complete honor for me to have this role. Very, very much so, is my first point. Second, I grew up as a supervisor in a tradition of collaboration. So seconding examiners to Banque de France, to the MAS in Singapore, and being a recipient of secondments inside the New York State Banking Department. And I know firsthand the richness of perspective and the learning that can be achieved by having a broader perspective on risks and opportunities and how to do the role most appropriately. So I would be very much in favor of this type of shared supervisory experience. And I know that the US would benefit a great deal. I had the chance to work very closely with colleagues at Banque de France when I was a supervisor, and I learned a lot from it. So thank you for the question.
Okay.
Thank you. Thank you very much, Elizabeth. I think we have to close this very rich and interesting session. I really think that this cross-fertilization process in the ECB is valuable, but also among our community. As you know, the impact or the action of American banks in Europe is very strong. As you know, probably the asset financing in Europe is more or less around 50% by 3 or 4 American banks. Then we are very conscious that we need to have and understand convergence between both sides, and not just convergence, but to understand both frameworks of regulation, surveillance, and so on, as you mentioned, that have major also level playing field impact. I think those issues are very important. The dialogue is absolutely necessary. Obviously, you mentioned compensation. That's after the question of the Ministry of Finance. My conclusion is on the fact that beyond all those regulation practices and so on, the people count, and the new layer of reflections is not just compliance, which is sometimes quite bureaucratic, but it's all the new layer of conduct. And I think if we want to reinforce resilience, give trust to the financial industry, we really have to work together with the supervisors on the conduct issue. And I thank you very much for this contribution, which is totally in line with the EIFR, European Institute for Financial Regulation motto. And our motto is about 3 or 4 ideas. It's responsible regulation, meaning the regulation in line with some strategy, how to finance growth in Europe. Second, smart regulation, and which is not the better regulation of the English, but smart means the balance, how we can all the time reach the proper balance. And second, lean regulation, like in industry. Lean means how we are cost conscious about the cost of regulation and how that is balanced with not just resilience, but profitability. Okay, Elizabeth, I was very pleased to see you again here and to share. And I think we'll try to have other type of rendezvous on other subjects because there is a lot of subject that we want to share with you. Thank you very much. Merci à tous les participants d'être venus aujourd'hui. À bientôt.
Thanks, Elizabeth. Thank you. Bye. À bientôt.
Thank you.